Well-capitalized players are already acting, using volatility as a tool rather than a threat. This is the transfer point, the moment when fear changes hands and value quietly shifts toward those who anticipated instability. The public often assumes these price swings are exaggerated or irrational, but from the market's perspective, they are logical. When trust in the system is questioned, risk must be repriced immediately. Even a short reporting blackout sends a powerful signal that control may be weaker than assumed, and once that doubt enters the system, it spreads fast. Investors don't just question the data that's missing. They begin questioning everything that depends on it. That's when selling accelerates, not because of what is known, but because of what might be hidden. This is where opportunity and danger exist side by side. Volatility created by transparency failures is not random noise, it is a message. It exposes who is prepared and who is pretending. Those who understand market structure recognize these moments as inflection points, not endings. They know that when information flow breaks, emotion takes over, and emotion always overreacts. For the disciplined, this chaos becomes a signal. For the unprepared, it becomes a trap. And that single difference is often what separates long-term winners from those who exit the market convinced it was all unfair, never realizing the system worked exactly as it was designed to. But to one is, when uncertainty hits the market, institutional players do not wait for press conferences, official statements, or social media explanations. They move first, quietly and decisively, while the public is still asking what happened. Large funds are already adjusting exposure, reallocating capital, and protecting positions. This isn't luck or insider magic. It's structure. Institutions are built to act on incomplete information because waiting for full clarity in financial markets is often the most expensive mistake you can make. The average investor believes everyone receives information at the same time, but that belief collapses the moment markets become unstable. Institutions operate with risk teams, scenario models, and predefined triggers that activate the second uncertainty appears. If volatility spikes beyond a certain threshold or data reliability drops, actions are taken automatically, positions are hedged, leverage is reduced, and liquidity is secured. There is no emotion involved, only execution. This speed creates a widening gap between those who react and those who anticipate. What makes this gap dangerous is perception. Retail investors often assume that hesitation is safety, but in fast-moving markets, hesitation is exposure, while individuals wait for confirmation. Institutions are already pricing in worst-case scenarios, and by the time clarity arrives, the major moves are often over. Prices have adjusted, risk has been transferred, and late decisions are made at far worse levels. This is why markets feel unfair during disruptions, not because rules changed, but because preparation levels were never equal to begin with. Another uncomfortable reality is that institutions benefit from confusion without creating it. They don't need to cause disruption, they simply know how to operate within it. When reporting goes dark or data becomes unreliable, liquidity thins out. Thin liquidity magnifies price movement, and price movement creates opportunity for those who can deploy capital calmly. This is how wealth moves quietly during moments when the public feels loud panic. The less clarity there is, the more valuable experience becomes. The real lesson here isn't about blaming institutions, it's about understanding behavior. Markets are not democratic systems, they are competitive systems. They understand that in moments of uncertainty, doing nothing is still a decision, and usually the worst one. If you want to survive in modern markets, you must stop waiting for perfect information and start building strategies that function even when the picture is incomplete, because that's exactly when the biggest moves are made. When markets begin to slide during moments of disruption, most people assume it's because something terrible has already happened. In reality, the damage often comes later. The initial shock is not about lost data or missing numbers. It's about lost confidence. Financial markets are built on trust. Trust in systems, in reporting, in counterparties, and in the belief that prices reflect reality. The moment the trust weakens, even slightly, capital reacts with speed and force. Confidence is invisible, but its absence is loud. When investors sense that the system may not be fully under control, they don't wait to be proven right. They act preemptively. This is why billions can move in minutes without a single confirmed fact. Money doesn't need proof to move. It only needs doubt. Once doubt enters the market, it spreads faster than any official reassurance ever could, because fear travels on instinct, not logic. What makes this so powerful is leverage. Modern markets are heavily leveraged, meaning confidence acts like glue, holding positions together. When that glue dissolves, positions unwind violently. Margin calls trigger forced selling, liquidity evaporates, and price declines accelerate. None of this requires bad earnings weak fundamentals, or economic collapse. All it takes is a moment where participants begin questioning whether the system is functioning as expected. Confidence breaks first, numbers follow later. This is also why official explanations often arrive too late to calm markets. By the time statements are released, capital has already repositioned. The market doesn't wait to hear that everything is fine after it has already priced in the possibility that it might not be. Rebuilding confidence is far harder than losing it, and it rarely happens in a single trading session. Once shaken, trust demands time, consistency, and proof, three things markets rarely have patience for during periods of stress. Here's the hook most people miss. When confidence collapses, the movement of money isn't random panic, it's survival behavior. Investors rush toward assets they believe will still function if the system stumbles. Cash strengthens, volatility explodes, and perceived safe havens attract aggressive inflows. This is not emotional chaos, it's rational self-preservation under uncertainty. Understanding this dynamic changes everything. You stop asking why the market is overreacting and start recognizing that confidence, not data, is the true engine of price movement. Those who grasp this don't chase headlines. They watch trust levels, because once confidence cracks, the market has already chosen its direction long before the facts catch up. But when markets experience sudden disruption, the language used in headlines is almost always the same. Trillions wiped out, value destroyed, money vanished. But this framing is misleading. In reality, capital is rarely destroyed in moments of extreme volatility, it is redistributed. Every sharp market move represents a transaction, a transfer from one participant to another. Losses on one side are mirrored by gains on the other, and this is where volatility becomes the most efficient mechanism for moving wealth. The reason this transfer feels so brutal is because it happens under pressure. Panic forces selling at unfavorable prices, while preparation allows buying when fear is highest. Investors who react emotionally sell to those who plan for exactly this environment. This is not exploitation. It is how markets clear risk. Volatility accelerates this process. Compressing what would normally take months into hours or even minutes, the faster the move, the greater the advantage held by those who remain calm and liquid. What separates winners from losers in these moments is not intelligence, but readiness. Those who enter markets without risk management, without cash reserves, and without a clear understanding of volatility are exposed the moment prices move against them. Forced liquidation becomes inevitable. Meanwhile, disciplined players are not scrambling for answers. They are executing strategies that assumed instability from the beginning. For them, volatility is not a surprise. It is the environment they prepared for. There is also a psychological layer most people underestimate. Volatility doesn't just move prices, it reshapes belief. After violent market swings, many investors lose confidence not only in the market, but in themselves. They exited the worst possible time, locking in losses and transferring future upside to others. This is how long-term wealth changes hands, not through clever predictions, but through emotional endurance. Those who can sit with discomfort gain access to opportunities, others abandon. Here's the hook that reframes everything. Markets do not punish fear, they monetize it. Every surge in volatility creates a pricing distortion, and distortions attract capital that knows how to wait. This is why the biggest fortunes are often built during periods everyone else remembers as disasters. Volatility is not the enemy of wealth, it is the engine that moves it from the impatient to the prepared. Once you understand this, market chaos stops feeling like a threat and starts revealing its real purpose. When core market systems fail or reporting suddenly goes silent, the disruption exposes something far deeper than a technical problem. It reveals how fragile the modern financial structure has become. Global markets now depend on centralized infrastructure, synchronized data feeds, and uninterrupted digital reporting to function smoothly. When even one of these pillars weakens, the entire system feels it instantly. Prices react not because participants understand the problem, but because they realize how dependent the system truly is. This dependence creates a false sense of stability during normal times. As long as data flows continuously, markets appear efficient, liquid, and well-controlled. But when that flow is interrupted, even briefly, cracks appear. Participants begin questioning whether other systems could fail next, whether safeguards are sufficient, and whether risk is being properly measured. This is when confidence starts to erode, not because of a known flaw, but because of the realization that complexity itself is a risk. The reality is that modern markets are tightly interconnected. A disruption in one reporting system can ripple across asset classes, exchanges, and time zones. Liquidity providers step back, spreads widen, and price discovery becomes distorted. These are not signs of panic alone. They are symptoms of a system recalibrating under stress. The market is effectively stress testing itself in real time, and those moments reveal weaknesses that are invisible during calm conditions. Here's the uncomfortable hook. The more advanced and automated markets become, the more vulnerable they are to failure at scale. Speed amplifies efficiency, but it also amplifies risk. When systems fail, they don't fail slowly. They fail everywhere at once. This is why even short disruptions can trigger outsized reactions. The market isn't just reacting to the outage, it's reacting to what that outage represents, a reminder that control is never absolute. For investors who understand structure, these moments are revealing. System failures highlight which assets rely most on constant liquidity, which strategies collapse without perfect information, and which participants are overextended. This is where weak models are exposed and strong ones prove resilient. The lesson is clear. Stability in modern markets is conditional, not guaranteed. Those who build strategies assuming uninterrupted perfection are the most vulnerable when reality intervenes. And when the system shows its cracks, the market responds not with patience, but with speed. The price. When market disruption hits, the difference between panic and progress becomes painfully clear. Unprepared investors see chaos as a threat, something to escape from as quickly as possible. Prepared investors see it as information. They understand that markets reveal their true nature under stress, not during calm conditions. Disruption strips away noise and exposes what really matters: liquidity, positioning, and discipline. For those who are ready, chaos is not a surprise, it is confirmation. Preparation in markets is not about predicting the exact event, the headline, or the timing. It's about building a strategy that functions when things go wrong. Investors who survive disruption don't rely on hope or constant reassurance. They rely on structure. They manage risk before volatility arrives, not during it. They size positions conservatively, keep liquidity available, and accept uncertainty as part of the game. When disruption hits, they don't rush to act. They already know what to do. Here's the hook most people miss. Chaos sends signals, volatility spikes, correlations break, and behavior changes across asset classes. To the untrained eye, this looks like disorder. To the disciplined investor, it's clarity. These shifts reveal where stress is building and where confidence is leaking. Instead of reacting emotionally, prepared investors observe. They let others reveal their weaknesses first. This patience often becomes their greatest advantage. Another critical difference is mindset. Prepared investors don't personalize market movement. They don't see price drops as insults or rallies as validation. This emotional distance allows them to stay rational when others are overwhelmed. While panic-driven decisions are being made in seconds, disciplined decisions are being made slowly, deliberately, and with context. In volatile environments, emotional control becomes a form of capital. Disruption doesn't reward bravery or bold predictions, it rewards resilience. The investors who benefit most are rarely the loudest or most confident. They are the ones who respected risk long before it was fashionable to do so. When the market stabilizes, they are still standing, still liquid, and still positioned. Chaos didn't break their strategy, it proved it. And in a world where uncertainty is no longer the exception, but the norm, treating disruption as a signal rather than a threat is no longer optional, it's the price of survival. So as markets open and headlines scream confusion, remember this: calm beats clever, preparation beats prediction, and patience beats panic. The system doesn't reward emotions, it exploits them. If you want to survive and thrive in modern markets, you must stop reacting like a spectator and start thinking like an operator. Learn how the game works when the lights go out, because that's when the real moves are made. So